Hello everybody, it's me the Boss Hog, and today we're going to look at my buys, sells and dividends for the week ending the 14th of January, which is quite a lot of trading honestly, in a week that was pretty volatile, and I just about managed to eke out a small profit. Let's do it. Alright, so first of all, public disclaimer, I'm still recovering from a cold I had midweek, but more or less there, but if I sound croakier than usual, that'll be why. In terms of how the week went, you can see it was pretty much a week of two halves, but within that, like I said, there's quite a lot of movement, if I'm honest. So some things to call out. Games Workshop had a pretty steep fall. This is a UK listed FTSE 250 company that I'm pretty bullish on. I'm actually going to be doing a video on this probably coming out tomorrow. It's already about 80% complete, so that's pretty exciting. And yeah, as you'll see in a second, I was buying into that drop. Next up was Hollywood Bowl. At one stage, this was a company that was the largest in my portfolio. For no obvious reason at all, as far as I can tell, it basically has been popping for the last couple of weeks. It's more or less now at fair value, in my opinion. So I decided to sell a third of my shares, as we'll get to in a second, but still a pretty great week for what's still a fairly large holding in my portfolio, so that felt really good. Speaking of fairly large holding was Genius, that went completely the other way. No obvious reason why either, other than the wider sentiment around, not yet profitable tech stocks. They've got a roadshow at the end of the January that I'm looking forward to. I'm down pretty heavily on my holding in Genius at the moment, down about 30%. Still optimistic for it, but I'm not yet brave enough to be buying into the weakness before I see that roadshow. So we will see. Disney also didn't have the best week. Compared to other stocks, it's okay. It was only down just under 4%. I've rounded it up there. And you'll see there's some moves regarding Disney as well in a second. Next up is Amcor. I also want to do a video on these guys. Yeah, I've spoken about them before. I decided also to buy some more. They had a little bit of a good week as well, to be honest with you. This is a semiconductor testing company, largely, is how I would summarize this. But I'm increasingly liking it. I just think it's turned a corner, basically. It's kind of achieved scale. It's got factory coming online in a couple of months, and I think it kind of warrants a higher multiple, an extremely pricey part of the market as well, so that's cool. And last but not least is BMY. Usually I wouldn't include this, but this is still just about my second largest holding, so 3% is material. So this felt pretty good as well. I've been convinced BMY is undervalued for some time, so I'm pretty green on this one actually. I've got my buy price under $60, so that feels really good for me. And yeah, feel pretty good about that. I'd also add as well that even though like some stocks, mainly like for example National Express or Phoenix, some of my larger holdings, National Express especially is my largest holding. They had like really good start of the week and then a really poor end to the week. So although they only moved like 1%, if you're recording, results on a day-by-day basis, that will have an impact, right? It's 25% of my portfolio, so that one stock can move my portfolio quite a lot. Having not added any money last week, I decided to add 1.6k this week. That was done in 3 batches, basically. I think Monday, Wednesday, Friday. I'm probably done for the month, if I'm honest with you. I still feel pretty poor. My bank account at the moment doesn't have much money left in it. I decided not to put anything in last week just in case, tech primarily showed further weakness this week. I didn't exactly spend this on tech, you'll see in a second, but yeah, decided to add 1.6k this week to buy into weakness essentially, so that was fun. Yeah, very significant trading this week. I mean, this represents, over 10% of my portfolio effectively, so yes, it's significant, I would say, in a single week. To do this, I haven't had so many weeks at this kind of level, but again decided to get busy. And I did have a nice dividend from Games Workshop as well. It didn't really make much of a dent in the 10% fall on the share price, but what can you do? So that's the high level summary. Let's have a look at my buys and sells next. Alright, so you can see quite a few buys in terms of unique companies, one of the longer lists. I've highlighted the ones in green here I want to talk about. If anyone wants to ask me questions about the ones not highlighted in green, feel free to do so. I'm more than happy to do so. So I'll start with Disney. So I decided to move pretty big onto Disney when it fell back below $150. For me, this is a very easy buy. I know the verdicts on Disney is a bit spread, especially in like the short to medium term. Like, had a look at analyst estimates, and they range from like $90 to $220. Pretty mental. For me, I kind of expect Disney to return to 2019 levels, and I'm expecting an EPS around $6. So for me, I'm basically getting like a $25 sorry, 25 times multiple, and I'm pretty happy with that for kind of a company that I think will return to profit. You know, he's going to be opening. I think Omicron and COVID in general is maybe slightly overdone. And yeah, I'm ready to buy a long-term holding for me at these kind of levels. No, it's not cheap, and I have to wait for a little while. But again, I'm in this for the long haul, and it was a chance to significantly increase my Disney holdings, so I'm happy to do so. I was really pleased with my Gamma buy this week. I basically promised myself if it was under 15.50 and then under 15, I was going to make a material enough movement to basically move my average buy price, which this level does. You know, I already had like 550 shares, so this is kind of increasing my shares count by the better part of the third. I feel really good about buying at 15.50, honestly. This is a share that I believe should be worth about 24 quid, so this feels fantastic. I am still slightly red on Gamma, but it's becoming less red as it goes on, and if I keep buying under 15.50, that would be even better. So yeah, so I still don't fully understand why the market reacted so badly to Gamma's last results. I thought they were solid, and I still think it's basically the best telecom there is to buy. And also it fits in with my aims this year of buying, you know, kind of like small to medium growth companies, reasonable values that are profitable, and, you know, will basically do me good in the long run. This is basically Gamma, and Gamma, to be clear, is like the very definition of a dividend growth long-term play. You know, they're increasing their dividend by 10 to 15% each year, and they're a very profitable, a very efficient company at improving their everything, basically. So I really like it. Games Workshop. So I won't go too much into this because you're going to get like a 20-minute video very shortly for anyone really interested. They had what I would describe as average results, and without going too much into that video, I think the management of Games Workshop knows that they maybe messed up or dropped the ball a little bit. There's definitely some reasons that this share price got punished. That said, I already felt like the share price was a bit undervalued, so it's like it fell back probably the right proportion, but I personally think that the market doesn't give Games Workshop enough love. So for me, you know, buying shares under 90 quid here was fantastic as an average. I was actually buying from 95, and as it went down, I just put more money in. Almost all of my new capital went into Games Workshop, so the 1.6k that I was originally planning to put into tech didn't really happen. Instead, I put it into Games Workshop and follow it down. My average on Games Workshop is now 95, so that's, again, I feel really confident at that kind of level. I think there's like a 25% also upside from my average price. So yeah, we'll see. This one I do want to spend a bit more time on. So if anyone follows me, you might remember a couple of months ago I spoke about getting back into house builders, and then I did for like 2 minutes until I sold and bought some other stuff. I think it was BMY actually. This time I made a more serious move into them. So, you know, you can see here I bought 850 quid in Persimmon, and let me just find the right line, and 400 quid into Red Rose. So Persimmon is, like, in my opinion, the best house builder. It's a very well run business, good metrics across the board, great dividend, maybe a high payout ratio, but zero debt, so what does it matter? It's just a very competently run business. Everything moved in the right direction, and because the results were only in line with expectation, it got, again, a bit underloved. I would say as well, though, actually, it's not just that. The whole housing sector in the UK got really beaten up, primarily because the government has decided that house builders should share the brunt of costs regarding the cladding scandal. I won't go too much into that for anyone who's not UK and might not have heard of it, but it basically means that house builders are going to be tapped for cost to fix something that was more or less everybody's fault except from the people buying flats with dodgy cladding. So I do expect it to be watered down. I think the market's overreacting, and actually, even if it's not, I think in the long term the fundamentals are still there for house builders. And, you know, for me, I'm not really a technical analyst. I like my fundamentals rather than my technicals, and the fundamental of the UK housing sector is just really good for investors in the long run. So yeah, Persimmon is my kind of like gold standard house builder. I think it's great, etc. Red Rose is slightly different. To me, this is more like an improvement play. Not that it was ever like a basket case beforehand, but management has decided that it wants to move away from the London and the southeast, where, you know, costs tend to be a lot higher, turnaround times, planning tends to be a bit slower, and they want to basically go like further afield, in up north primarily, where like the revenue is therefore going to be under pressure a little bit, but the earnings should improve, and over time they should be able to deliver more units. Their margins aren't great, especially compared to the likes of Persimmon and basically a lot of others in the industry. But again, I think like they're moving in the right direction here, and I like a turnaround play, so I decided to kind of split my investment sort of 2/3, 1/3 between those, and I had timed my buying really well here. Actually, both of them are already green, so that feels pretty good. So I will be buying more of these on weakness, and you'll see in a second like what I sold to buy these. I would be prepared to sell a little bit more if there is further weakness in the house building or these two stocks specifically. Next up, so Pets at Home. This is the UK Pets, not the US one, and also the UK EVR rather than the US one. I know this is like PetsMed and Evercore, I think it is. But these are the UK stocks, so Pets at Home and Everaz. I've owned both of these before, Everaz especially. I think it's my 4th time back into it. It was actually the first share I ever bought when I started investing. I'll start with Everaz then. So sort of a combination of the price of the shares and the price of iron ore means that it's attractive for me to start buying my stake again. I'd really like to buy a little bit more under 575, especially if the iron ore price is around the $120 mark. Now, when I was reading up on Everaz, and by the way, I have a whole video on why I prefer Everaz to Rio, I mentioned in that video that like 20% of their earnings are from coking coal, and Everaz have put it under review that they might be selling that off. Well, when I was buying this, I did some cursory updates and realized that they have now decided, literally 2 days before I bought the shares, to offload their coking coal arm. What that means for me is effectively that I will end up with about 10% of my stake back in cash when it gets divested, because my brokerage doesn't have access to the Moscow Stock Exchange where the coal business is going to be listed. I think it's kind of okay. The agreement that's been struck is fair. It's not really beneficial either way. All of the major shareholders who have about 55% of the business are basically taking their full allotment of the new coal, which actually makes me feel reasonably good that this is for the reasons that they're saying, which is basically they're going to run the two businesses as separate businesses. They think they can release more shareholder value. I'm kind of agnostic about it. Like, I totally get that argument. I think it's valid. However, I would argue Everaz has really benefited by having coking coal as part of its earnings, and also 70% of Everaz's coal that it uses in steel production and iron ore production to a lesser degree comes from itself. So although coking coal has been going up in price, putting pressure on kind of other iron and steel producers, not so much with Everaz. So it's kind of more focusing on its iron and steel play and moving away a little bit. It's put in place medium term, I would say, like 4-year agreements with the new coal company. So just something for you to be aware of, because like I say, I'm pretty bullish on Everaz. I do still like it, but if you're only watching that video, it's changed a little bit since then. That's what's going to be happening. And certainly one of my subscribers who I think because of me bought Everaz, I already notified them. I sent them an email just to let them know that this was happening and see if it changed their opinion or not. So fine. Next up, we got Pets at Home. This was actually one of my wife's picks, but it did really well for us. We bought it originally at like $4.20, sold out at just under £5. Since then, it's fallen back quite a lot. And for me, I've been buying very slowly anyway, at like 460, 450, that kind of level, but decided that I could buy a lot more at 430. And to me now, it's like a good enough business to be happy buying at that level. I think there's like a solid 20% upside or so. When it was like approaching the high 400s, to me it was fair value. That's why I sold out at like 495, 498, whatever it was. But back down in the 430s and 420s, this is now another good buying opportunity for me. So this is something that I'm buying rather than my wife's pick. And yeah, happy to do so basically. So back into both these companies because they've had modest fallbacks, but material enough to get me interested again. And last but not least, I wanted to talk about this company in a bit more detail. It had a nice update. Basically, it was very quick to move into products that would be linked to hygiene because of the pandemic. And even though the kind of revenue from that has now like dropped off, they've done a terrific job of filling in that revenue gap. It's my smallest cap owning by quite some margin. It's only worth about £65 million in terms of market cap, so very, very small company. But it's also like really good quality, very well run, conservatively run. I think it's it's just worth some attention and some love, basically. You know, depending on how they grow, we'll see how my stake goes. But I really timed my buy here very well. So I'm really happy with this buy price in the 80s. I bought, I think it was 200 at 82, and then the rest at 80. I mean, that's what this looks. By the way, my average pricing here, obviously it's in pounds, so some of the dollar shares look a bit weird, but it does include any fees I get as well. So that's why sometimes when I sort of say, you know, I bought it at like 400 and then it displays at like 402, it's because there's like, you know, stamp duty charge or any FX fees as well. So this is my all-in average, basically, not just on my share price. So yeah, quite a lot of my buys to talk about, but I just wanted to explain why, because obviously it's a pretty big week, so I think it needs some attention. Anyway, with the exception of Games Workshop, everything else I bought here, I had to sell shares to do so. So let's have a look at my sales next. Alright, so a much smaller list in terms of unique companies. I'm going to talk about most of these with the exception of BMY, who I feel like I've spoken about before. And I mentioned beforehand I was probably going to trim between sort of 30 and 50 more shares. And this is kind of that. So I don't want to spend any more time on BMY than that. I think that's enough for now. So I'll start with EPD. And again, this was a company that was my largest holding at one point. I've more or less sold out of all my stocks now. I had 550 just a few weeks ago. So I've been spreading that out for various reasons. This one was mainly for, you know, just, I mean, there was Crichton's, there was Everaz, there was Pets at Home, there was Amcor. I've basically been spreading the love by doing just that. And the final one I did where I got rid of, I think it was my last 250, was to buy Disney under 150 on Friday. So there's that. So yeah, I got just under $24 average here. I think it's perfectly fine. I have a fair value myself of $28 for these shares, but I expect it to be under pressure for some time. I think the market in general doesn't give enough love to these kind of companies. I think there's money to be made here. Anytime that the yield on the dividend, which is massive, is above 8% for me is like a great buy. And I would happily get back into these under like the $22, especially if it goes that low again, like it did last quarter. And I'll be keeping a very close eye on this, which is why I decided to keep one share. But for me, it's just a very safe place to put your money, which is what I've been doing and almost how I've been treating it, with a dividend as well as lovely. And I just decided to basically withdraw that money in the short to medium term. So we'll see if that turns out to be a good decision or not. I feel fine with it for now. Like I say, but I do feel like I didn't get the best value for this, but I also sold it reasonably well as well, so that's okay. And I've made lots of money from EPD. You know, my buy price was I don't know, 10% below this, and I've been enjoying dividends for a few months as well, so that feels great. Next up is Hollywood Bowl. So yeah, as I touched on, this is my largest holding. I sold 1/3 of my shares, so you can see here I sold 1,000 shares. I've still got 2,000. Math checks out, hopefully. Now the buy-sell spread on this is medium for, you know, it's a smallish company. Market cap's just under 400 million. It's just a very good company in my opinion. Everything is run really well with it. Somehow it's managed to eke out a very small profit for the last 2 years, despite being, you know, impacted by lockdowns. I think it's going to recover really well. They had a trading update, I think, in October that left, you know, it could have been a bit clearer. And then the full-year results were delivered, and I thought they were really solid. I was surprised pleasantly from their trading update, and then looking at their numbers, that they did manage to eke out a small profit. Still got 30 million in cash. You know, they're growing still. And yeah, so I think this is basically at fair value, close enough. I decided to profit take effectively, but I still like the company enough that I want to keep you know, a reasonable holding forever. So my plan here is to sell a maximum of 500 more shares, and I'll do that if Housebuilders, or maybe, you know, like Restaurant Group or WH Smith, you know, these kind of like companies that are going to benefit from turnarounds but might have a volatile short to medium term. You know, if any of those kind of shares in what is my wife's ISA drop, then I'll consider selling 500 more. But I'd like to keep at least, you know, 1,500 at, you know, £3 a share or so would be sort of, you know, nearing 5% of my portfolio to still be a reasonable holding. I expect this company to resume dividends once they manage to get a full year open, and realistically I expect them to earn about 25 million in a full year, and they're currently ranked at like 400 million market cap, so 16 PE. I think that's perfectly fair, and that's, you know, assuming that I'm reasonably close on those numbers. I think it's fairly valued, and I think, you know, you'd probably be looking at sort of probably a 10p dividend. Is that too high? Yeah, maybe like a 10p dividend, something like that. And you'd be very happy with that kind of output from the company, assuming that they still have enough capital. Payout ratio, I think they wanted to hit 50% before they had to cut their dividend. This is a fairly newly listed company, so it doesn't have like huge dividend histories even before COVID. But yeah, it's super well run. I don't think it's a buy at the moment, if I'm honest. For anyone who got in earlier, I think it's great. No idea why the market took 10 months to move and then just decided like, well, hang on a sec, this company is worth like surging since like late December, but there we are. So I'm very happy with my sell here. It's close enough to my fair value that I'm no complaints at all. And like I say, I picked up Persimmon and Redrow primarily, as well as a few other bits in doing this. So that felt good. National Express I continue to trim. I would argue this is not an amazing price, but I've become increasingly uncomfortable having 25% of my stock portfolio into one share, especially a share that is, not necessarily the sexiest. This is a real value play. So I wanted to get to 270 before I started trimming my share. I still want to get to 270, but I've trimmed 400 of my 10,000 shares. My plan here in the medium term, so let's say the next 12 months, is to get my holding from 10,000 down to 8,000, and I'd like to average around 285 for that disposal. So that's my kind of medium term target. I still would like to keep about 8,000 shares until the company gets to about 330, something like that, and then reassess when everything is firing on all cylinders again. So I think I have a fair buy price here, and I think the market continues to not give what's a good company who's navigated COVID extremely well enough attention. So there it is. And last but not least, this is Frontier Developments. I mentioned already that I wanted to get into like small to medium growth plays. This is a games developer, UK listed, pretty expensive shares, and I have to say they put out a dreadful update. The shares rightly got punished, like they went down 35%. I just decided to cut my losses. I didn't want to be in this company. Like, I mean, it's an industry I don't fully get anyway. I mean, I like gaming and all the rest of it, but all the multiples are crazy. It's an industry that relies on sort of blockbuster hits, and you can never tell what's going to land and what didn't. Basically, their stuff didn't land at all. I felt like their excuses were silly. Like it just sounded like a business not owning up to its mistakes. Whereas, like, to compare that, by the way, to Games Workshop, like that was a business that to me owned up to its mistakes, and I'll explain why in a separate video. But this was like a lot of like whining about the competitive landscape. It's like, come on, guys, you're in a competitive landscape, right? You're meant to be explaining to me as an investor why it is that you're navigating that and what you're going to do to return value to me. I just had no time for it, basically. I had a very, very small holding in it anyway, like 60 quid. So I lost 20 quid. But yeah, it was a dreadful update. I wouldn't touch this company even at its current value, which is still trading on a really hefty multiple. So I've decided to just exit probably the games industry, or certainly that kind of level. I think like if you want to get into the likes of Nintendo and other like major developers that are run very differently, and games companies, etc. more generally, that's I think is good, because I think that industry is going to continue to grow. But this is like the fringe, basically. Those developers, you can never tell what's going to happen. So just a little one I wanted to talk about, because I think it's important to like reflect on losses, and this one, a very small loss, but it made me cringe and laugh at the same time when I saw it. I was really glad I didn't have a larger stake, because yeah, absolutely deserved the fall. Anyway, a slightly longer video than normal, even by my long standards, but not as long as I was expecting, actually. So there you go, that says something. Anyway, tune in tomorrow if for anyone who is interested in Games Workshop specific video. Hopefully this was interesting. Like I say, very active trading at the moment. We'll see if that pays off in the long term. And yeah, eked to a small win, and I'm very fractionally up for January to date, but it's pretty wild ride, I'm sure, for many people at the moment. So we'll see how it shapes out. Nothing else to add. So thank you very much for watching, everyone. I've been the Boss Hog, and good luck with your investing. Bye for now.